will be available for viewing on demand on our TWU SMMC YouTube channel within about a couple of days of this presentation. So welcome to Meet with an Expert, Life After College and Your Student Loans. Tonight's presentation will focus on what to expect after college when your student loans go into repayment and the information you need to know about your repayment plan options. My name is Shalise Connors. I'm the director of the Student Money Management Center, and let me begin by welcoming all of our students that are with us right now, and those of you who are watching this on recording on our YouTube channel, particularly all those who are going to be graduating in December in like about a month. Congratulations. This is an incredibly exciting time for you, and we wish you all the best. Thank you so much for joining us. The Student Money Management Center serves all students on all three campuses. This amazing resource that we have for you is free, even after graduation when you are a wonderful alum. We bring you programs such as the one tonight and so much more throughout the school year. Please follow us on Instagram or Facebook. Our TW Maroon Money is our handle, and that's also the handle for our YouTube channel. Online with us this evening is Gabby Pringle Owanaka. She is our Student Money Management Center Assistant Director. And then we have our experts from the TWU Office of Financial Aid. We have Elizabeth Mendoza and Brandy Henry. And this program is also being sponsored by the Spendwell Committee of the TWU Health and Wellbeing Initiative. We do appreciate the continuing support of those co-leads for that committee, and that's Stephanie Compton and Gabby Pringle Owanaka. And our featured presenter this evening is Jeff Lackey from Sallie Mae, and I will introduce him here in just a moment. We do have a few housekeeping items to pass along. Like I said, this recording of this info session is going to be posted on our YouTube channel within 2 to 3 days. We're going to take questions in the chat. We're going to take those and answer those at the end of Jeff's presentation. So please feel free to put questions in the chat, and they're going to be monitored by Gabby. And then we will open up the floor after the presentation for any questions you may have. If you want, switch your viewer to speaker view so that you can see the speaker and the slide deck presentation. And again, students, we really do encourage you to ask any questions that may be confidential or particular to your TWU financial aid situation. If you've got something that's unique to you, please communicate directly with either Brandy or with Elizabeth in the chat. You can directly chat with them, and they'll be able to answer your confidential information, or at least make an appointment with you to get some more answers for you. And we do want to maintain your privacy while we get those answers for you. When you exit the survey, a really short 6-question anonymous survey is going to pop up, and I ask that you please complete it because your feedback is really important, so we understand how you enjoyed the presentation and what areas of improvement we can do to bring you more of this kind of content. All right. We're fortunate this evening to have an expert with us to help you navigate student loan repayment. Jeff has several years experience in the higher education industry, most recently as the Director of Financial Aid at Peninsula College in Port Angeles, Washington. He is involved in the Utah Corporate Development. He's involved in UASFAA, something with financial aid, and the Corporate Development Chair and the Washington Financial Aid Association Early Awareness Financial Education Committee. So it's a natural that he should be with us tonight. In his role at Sallie Mae, Jeff is a Director of Relationship Management, and he oversees higher education and high school relationships throughout the Pacific Northwest and Northern Rocky Mountain region. He resides in Post Falls, Idaho. He is pinch hitting for our regular speaker, Sergio Gonzalez, who's located in Houston, could not be with us tonight. We are so happy, though, to have Jeff, and I will turn the program over to you.
You bet. I appreciate it, Shalise, and thank you everyone for joining tonight. Really appreciate dedication to understanding more about what's going on with your student loans and how to obviously set yourself up for success when you enter into repayment as you move, as the title of this presentation says, into your life after college. We'll cover a lot of information tonight. We're going to try and do it very efficiently to make sure that we're giving you enough information, but that we're also doing it efficiently so that we're not cutting into too much of your night. With that, let's just go ahead and get started. Shalise did mention if you do have specific questions, go ahead and put them into the chat. I will be available to try and answer as many as I can at the end, as well as the TWU staff answering specific questions as well. So let's go ahead and start off and discuss about the different types of loans that you could potentially have used in order to fund your education while you were attending TWU. You can have what are called private loans, or you can have what are called federal loans. And essentially, you may not have, hopefully, you know the difference between the two. But if you haven't, if you just simply stated, I know that I have certain types of loans, that's fine too. That's exactly what tonight is designed, is to try and help sort some of that out and to try and get some information in your hands so that you can better plan and manage the loans and the various different potential repayment options and repayment terms that these loans potentially carry. So let's talk a little bit about what the difference is. So simply put, a federal loan is going to be a loan that is provided by the federal government. It is, you borrow directly through the U.S. Treasury. These loans typically have a name that start off with the word federal, like Federal Direct Student Loan or Federal Direct Subsidized Student Loan, something along those lines, or Federal Direct Unsubsidized Student Loan. They will have various different derivatives of that, but they should always have the word federal in front of them. The nice thing about the federal programs is that they have fixed interest rates. And so around a certain time of the year, usually around the end of May for a July 1st start date, you will have a fixed interest rate that is assigned to that loan, and that fixed interest rate will be on that loan for life. Then the next year that you were coming into school, around end of May or so, that interest rate would be decided for implementation of any new loans for the next July through June period afterward. But so you may be asking yourself, okay, I've got 4 different federal loans, but they have 4 different interest rates. That could potentially be the case. However, because your first year loan that you took out could have one interest rate assigned to it, that interest rate is not going to change on that loan for the life of the loan, as long as you keep it in the same format that it is. And then your second year loan will have a different interest rate, but again, it will be fixed as well and it will not change. So you can have 4 different loans with 4 different interest rates, but they will all be fixed and they will not change unless you, as we talk about this further into the presentation, do something where you would be actually changing the status or changing the actual configuration of that loan. You did need to file the FAFSA, the Free Application for Federal Student Aid. You did need to file this document in order to be eligible for the federal loans. So if you have attended school and you've not filled out a FAFSA before to attend, chances are you do not have a federal loan. A private loan is a little bit different. A private, or what they call alternative loan, is a loan that would be supplied by a bank or a lending institution. It could also be a credit union as well. Because these loans are specific to the various different types of banks or lenders that have these types of loans, they can either offer a variable, a fixed, or they can offer your choice between a fixed or variable interest rate on the loan. These loans are going to be credit-based, which means that when you apply for a loan, you are going to have your credit checked in order to make a determination on whether or not you would be approved or denied, or maybe a counteroffer denied, but with, reapply with an eligible cosigner. And that's what typically the private loans will look like. And a cosigner, which is something that you did not need in your federal student loans, a cosigner would be somebody that would share the responsibility in the repayment of this loan. So if you do have to if you do remember going out and having to talk to a significant colleague or friend or so in order to have them co-sign on the loan, then chances are you have what is called a private loan. So the 2 types of federal student loans, I did kind of briefly mention them. The main power horse direct loan program is federal loan program is the direct student loan. And so it can come in 2 different forms. It can come in the form of a direct subsidized loan or a direct unsubsidized loan. Both of these loans were the same program. However, there were some slight features that were different between the two. Both loans were eligible to undergraduate students that demonstrated, well, I'll say need, maybe I should say, demonstrated that they were eligible for them within your financial aid offer. A direct subsidized loan, however, though, you needed to demonstrate what was called need, meaning that when you took the cost of attending TWU and you subtracted your other type of aid that you've received, then basically, if you had what was called a positive gap or a positive unmet need, meaning you still needed some eligibility covered in with some sort of a financial aid award, you could potentially have been awarded a direct subsidized loan. The direct unsubsidized loan is a loan that was you were not required to show financial need. And the nice thing about this loan is let's say by chance you had a family contribution that you had to uh, satisfy. You could have used a portion of this loan or some of this loan to help satisfy the family contribution based on your FAFSA. So basically, if you do happen to have your financial aid offers, or if you've got any disclosure statements or promissory notes that you've decided to keep, you can certainly check, and they will be specific to what type of loan you have, a subsidized or unsubsidized loan. The other benefit on a subsidized loan is that while you are in what is called an eligible deferment, and the most popular deferment that's utilized for these loans is the in-school deferment. While you are in school, the U.S. government, it picks up the interest on your subsidized loans. So right now, currently, while you're attending school, at least half-time status, you are not having any interest that you will be responsible for while you're in an eligible deferment. This also goes if you happen to separate from school, and let's say for a period of time you decide to enter the workforce and you decide to go to graduate school at a later time. And so you enter back into school at least half-time status. These subsidized loans will go back at the time that you go into at least half-time status. In future years, this will go back to the federal government subsidizing or essentially paying the interest on these loans for you. The unsubsidized loan in the direct loan program, you are responsible for the interest at all times. So as soon as that loan was dispersed to the school, you have interest accruing on that loan. You also have interest accruing on that loan during all different deferments and such. And we'll talk a little bit about the various different deferments coming up in some slides as well. The nice thing is both the subsidized and the unsubsidized loans have what is called a 6-month grace period. The 6-month grace period, and we'll talk again a little bit more about grace periods in the future, but you're not going to be responsible to start paying back on this loan as soon as you separate from school. You have what is called a 6-month grace period, which allows for you to leave school. Maybe you potentially have to move, relocate for a new job, do some interviewing and such, maybe get a new apartment or place of residence established. At the end of 6 months, on month 7, you would then be required to start making payments. So they give you a brief period to kind of get on your feet, get your affairs in order, and then you will start repaying on these loans. For your graduate students, for those of you that are in attendance tonight that are in graduate school, you did not have access to a direct subsidized loan. That was only for undergraduate students, but you did have access to the direct unsubsidized loan. However, in differing amounts, there were some dollar amounts, and a little bit of increase in eligibility that you would have under the graduate student loan program. It works essentially the same as the undergraduate features and benefits that I just talked about on the previous slide. The other loan that you had potential eligibility for was called a direct graduate plus loan. This was available to graduate students only. You were not required to show financial needs, so it basically is similar to the unsubsidized loan. You did not have to demonstrate financial need. All of these loans, both the subsidized, unsubsidized, and the graduate plus loans are completely deferrable while you were in school. So meaning you didn't have to make payments on them if you didn't want to. And they have the same 6-month grace period at the end. Remember, however, though, because these loans, the graduate plus loans, are unsubsidized, they work very similar to the direct unsubsidized loan in that you are responsible for the interest as soon as the disbursement was sent to the school. Direct graduate plus loans, unlike direct subsidized and unsubsidized loans, you could borrow the remainder of your need under a direct graduate plus loan, whereas the subsidized and unsubsidized direct loans had annual as well as aggregate loan limits. So some of you may be saying, well, I think I only applied for or and received one loan, but it wasn't enough to cover all of my expenses. That potentially could have been a subsidized or unsubsidized loan, but the Graduate Plus Loan program would cover all of your expenses after any other financial aid received. Now, private loans are a little bit different. Private loans are going to be loans that come from a bank or lending institution, like I mentioned before, but these loans are going to be specific for college financing. So these are not going to be considered if you happened to have gone down and talked to a lending institution about a personal line of credit or that you wanted to take out a personal loan or so. Private student loans are a specific program that was specific for college financing. These terms and costs, they can vary all by lender. So you can have Bank A, Bank B, Bank C. All of them may have various different interest rates. They may have them either be variable or fixed. Some of them may allow for you to borrow your entire cost of education minus other financial aid received. Some of them may only let you go up to an aggregate limit. Some of them may have an origination fee, some of them may have zero fees. The idea and the premise behind this is that every private student lender out there has their own terms, features, and benefits that they offer. So you probably had to do a little bit of shopping to determine which private loan worked best for you. Again, like I mentioned previous, this loan is credit based, so you would have to fill out the application. It would have to be determined whether or not you were credit eligible or not. And if you were credit eligible, you moved forward. These loans were certified by the school. So that's another benefit of private student loans is that the school does have some direction to make sure that your costs relevant to what you want to borrow is manageable, and that basically there is some controls to make sure that there isn't any wild borrowing or anything like that within these programs. You may have also found that when you did apply for these loans, that your credit you may not have had enough credit, or maybe you had a small derogatory on your credit or so that did not allow for you to get approved initially. But you received a counter from the bank or lending institution that stated that you would be eligible to reapply again with an eligible cosigner. And a cosigner essentially, again, is just somebody that helps share the responsibility, gives a little bit more security to the lender that lending to you for your educational expenses would be a good risk. And asking for that cosigner just basically helps reinforce that. If you did have a cosigner on your loan, then chances are the private student loan route is what you went and with, and that you do have some responsibility in knowing what specific lender you went with. And we'll talk about where you can kind of research these in an upcoming slide. So right now, currently, as I understand, there's about a month or so prior to you separating from school via graduation and such. Right now, currently, we are talking about the period or the column right in the middle of this slide. So basically, have various different loans, whether they be federal or private loans. This chart typically works for both types of loans with a few little nuances. So you can see in that first row talking about where you deferred your payments while in school. So if you took out a federal loan or you took out a private student loan and you decided to not make any payments while you were in school, which means also any fixed rate payments or paying the interest only while you were in school. Basically, you deferred the entire cost of that loan while you were in school. When you go into your grace or separation period, that 6-month period that I was talking about, you're not going to be responsible for making any payments during that grace period as well. However, when your grace period is over and you are going into roughly, let's say, month 7 or so, you will be responsible for making what they call principal and interest payments. Principal being the initial amount that you borrowed, plus any interest that accrued on that loan since you initially borrowed the principal. If you decided that you wanted to make some payments on your loans while you were going to school, whether it was just a fixed rate amount, let's say you decided you wanted to make $25 payments while you were in school, takes care of a little bit of interest, but it also helps me develop, good repayment habits. Or you decided I want to take care of all of the interest. I just want to make sure that when I graduate school, I only have to pay back the principal, so the original amount that I borrowed, as well as the interest. I only want to be responsible for that portion. So I'm going to take care of the interest while I'm in school. You will be responsible for still making that fixed rate amount of, let's say, $25 or paying the interest while you are going through your grace period, because this is part of your repayment term. You established that while you were in school, and you will still have to keep making payments on that. If after or excuse me, when you get to your grace period or your separation date, that is when you will start taking on additional principal payments. So you will combine the principal and interest payments together, and your payment will increase from, let's say, interest only. Let's say hypothetically you were paying $100 or so in interest a month, or maybe let's say $50 a month. When you enter it after your grace and you enter into your full repayment period, you will then be making principal and interest payments. So they will start allotting for the amount that you initially borrowed over the years of school. And so your payment will probably increase at that time. So I did kind of talk a little bit about what principal is and interest, but just in case this was the first time that you've heard those terms together, basically your principal, again, is the amount that you borrowed plus any unpaid interest that's been added to it. Now, sometimes, whether it be the federal government or a private lender, they will do a practice which is called interest capitalization. So some of you may have documentation, your disclosure statements, which essentially is a document every time that you received, and it could have been either been electronic or in paper. But a disclosure statement and disbursement statements will go out each time that a disbursement has been sent to the school. Your promissory note that you received is the actual, either electronic, for most practical purposes, it's going to be an electronic document that will typically show what you initially borrowed for that particular year or that particular loan cycle. And that will be considered your principal. And if you did this 4 times for first year, second year, third year, and fourth year of school, then you will have essentially 4 loans. And so those will all be potentially they could be added together if they were all federal loans. And essentially you would start making your payments on those balances after your grace period. The interest is the part that you are charged for borrowing the money. So essentially, both the federal government and a private lender will charge you interest on these loans. So basically, it's the cost of doing business, allowing for them to lend the money to you to pay off the expenses that you have for your education. And in turn, they ask for interest on that loan. And essentially, that's basically what they will receive as far as being able to go ahead and extend lending or extend a loan out to you. So basically, again, principal and interest will accrue on both types of loans, federal and private loans. Now, talking a little bit about interest capitalization. So going back 2 slides, I talked about students that may have opted to pay the interest while they were in school versus a student that decided to defer. It's basically a decision as to what you feel is best for you. Students did not have to pay interest on their loans. Most lending programs in the private sector allow for you to have a deferment. Some of them do require maybe a payment, but most of them require deferment. And then, of course, the federal government loans all have a deferment clause. But whether you decided to pay the interest while in school really can matter. As you can see in this example above, if you make interest payments in school, which would be the right column, the total interest paid is less than deferring payments to repayment. So basically, you can see that there's roughly $6,533 in interest that was paid during the in-school or your non-required period. That will roughly save you about $2,964 over the life of the loan because you took care of the interest while you were in school. It's not, again, not a requirement. And I know for some of you that are just coming to the end of your schooling, you're just now learning about this. But if you decide to move on with additional schooling afterward, whether in your graduate years or maybe receiving a second undergraduate degree in which you will actually need to borrow for more, this is a concept that you may want to learn about to see if you have the means to do so. And it's not going to sacrifice additional monies to take care of your house while you're going to school. If you can swing to take care of the interest, or even just making a fixed amount payment, you can really save over time the amount of interest that accrues over the life of the loan. So essentially, let's find out what you're going to need to know so that you understand what you owe. So if you haven't done so already, now would be a great time to try and put a list together of all the student loans that you have. And I'm sure also too that the financial aid office would help you fill in any gaps of any paperwork or any loans that you think that you may have taken out, but you don't remember or can't remember. But basically, try and figure out if they're federal or private loans. Typically, a financial aid offer from the financial aid office will help let you understand this a little bit better. If you still have that available or so, that would be great. But also, any of your, like I said, your promissory notes or your disclosure statements, either from the federal government, U.S. Treasury, or from private lender like Bank ABC down the street or Lending ABC online. Those could be potential signs that of the loans that you have. Make sure that you write down any of the servicers or their contact info. Just because you borrowed from, saying from the Department of Education or the U.S. Treasury does not mean that they are going to be the servicers of their loan. They may contract out with private companies in order to service, which essentially means collect the payments and manage the balances that you have over time, take care of any eligible deferments, potential loan forgiveness options, and such. Your servicers will take care of that on behalf of the federal government. Some private student lenders are not always even though they may be the lender, they may not also service the loan as well. They may contract out as well. So with a private loan, you will have to determine whether or not the initial borrowing entity or the lending entity, I should say, is also the servicer or if they've contracted out. And again, there should be some paperwork either that they've sent to you or it's online or if it's available in your lender portal, maybe a way for you to log in and get that information. Again, if you haven't done so already, if you do have copies of your promissory notes, your disclosures, any of those statements, if they came in the form of a mail, make sure that you put them in some sort of a central file or a location or so. If they came electronically, chances are they have a way for you to print off or save a PDF. I would do so. Your promissory note is going to be a picture in time of what the rules, rights, and responsibilities of that loan was at the time that you borrowed it. And that is a very, very important document to have. If for some reason there is anything that ever happens with your loans, and you've got a dispute, your promissory note is going to be the wealth of information that you're going to want to refer back to. So take some time either now or in your grace period and make sure that you get that promissory note, get a copy, a PDF copy, or if you received a paper copy, make sure that you relocate that and put it in a file for reference potentially. Hopefully you won't need it, but it's a great document to have. Also, too, in tracking your loans, you're going to want to find out of the various different loans you have, what your monthly payment will be and when they're due. Again, if you happen to be graduating in the next month or so and all the loans that you've taken out all have the same 6-month grace period, then you can make a pretty safe bet that all of your repayments, first payments will come about the same month. However, there may be a potential, again, on your private loans where a lender had a longer than 6-month grace period, or maybe they did not have a grace period at all. Maybe the program that you decided to go with that worked best for you, one of the potentials is that they did not have a grace period. So you might be responsible for that loan the very next month after you graduate. You want to make sure that you track all of that and so that you know exactly what your action dates are. If you have gone through your paperwork, or if you're going online and you just say to yourself, I cannot figure out where any of this information is, or I still have a few gaps here and there, you can go out to studentaid.gov and you can go to a section called Manage Your Loans. There, they will have a loan simulator. They will be able to allow for you to download all of your federal loans that you've borrowed. You'll be able to see them all out there, and you will be able to actually interact with the loan simulator and provide some information for you in regards to your federal student loans. As far as a private student loan, there is no central repository for private student loans. So what we typically advise students is, if you haven't done so already, you may want to consider pulling a copy of your credit report. You can go out to whatever credit report agency you want to pull that. We highlight annualcreditreport.com here only because it is a credit reporting service that is brought to you by the three major lending history sites out there: TransUnion, Experian, and Equifax. Typically, they will have the majority of all of your credit information out there. It's not 100%, but they are pretty close. So by utilizing that service, you can go out and pull your credit history and see if you have any loans out there that were education related. And if so, you'll want to make sure that you add those to your tracking document. If you don't have a loan tracking document yet, you can certainly take a look at ours at salliemae.com/student loan checklist. You can see it's broken down into various different relevant columns. Like I said, with the most important being probably the last column, your action date. That action date could be a plethora of things. If you are moving on from undergraduate school and you know that you're going to be going into graduate school and it's going to be within 6 months, your action date might differ than another student that is deciding to go into the workforce, where your action date is going to potentially be your first day that you need to make a payment on your loan. For the graduate, or for the student that's moving on to graduate school, your action date might be to inquire about a deferment to make sure that your loans stay deferred while you are moving on to graduate school. The other thing about your tracking your loans is, once you've actually gone into repayment, your action date might be a day that you need to file for another deferment, or for a day that you need to file documentation in order to qualify for a certain type of repayment program. This document will help keep track of all of the actionable dates that will make sense for your particular situation. So, talking a little bit about some of those repayment options, there are going to be various different options out there. Now, if you're out looking at some of the news media and such like that, there's a lot of information about some changes that are going on within the federal student loan programs, as well as the repayment options. The One Big Beautiful Bill Act is in the process of streamlining a lot of the federal student loan repayment options. And so after July 1st of 2026, some of the repayment options might look a little different than what is currently out there. However, remember this: all of your loans that we're talking about as of today prior are going to be eligible for all of the repayment programs that we know of that are eligible now. Unless something changes where they may potentially get rid of some student loan programs, repayment programs, and roll them all into one. And the reason why I say it that way is that there is still some negotiations going back and forth on this. Uh, Basically, you will have what they call standard repayment options. You will have extended repayment options, and you will have graduated repayment options, all available to you. Some of the changes that might be coming is what they call in what they would call the income deferred repayment periods. And we'll talk a little bit about them. But those are the ones I just don't want you to get confused out in the media right now. If you do decide that you are potentially going to need some sort of an income contingent program, when you go out to studentaid.gov, those programs that are available out on their website right now are available to you. And like I said, as we move and get a little closer to July 1st of 2026, we'll see how many of those programs you'll still stay eligible for, or if any of those programs might morph into a new program that's a little bit more streamlined. But getting back to it, I want to make sure that we cover quickly all of the different repayment programs that are out there. You've got a standard repayment, which is going to be anywhere from 10 to 25 years, depending upon your balance. Um, you then also will have an extended repayment plan, which does allow for you to have a little bit longer repayment period, which will help lower some of your payments at the beginning, and then extend the period out a little bit more. Now, granted, you may end up paying a little bit more interest in this type of program, but it does allow for you to have a little bit more manageable monthly payment than the standard plan. You also will have what is called a graduated repayment plan, which basically starts out with lower payments at the beginning and they, over time, get larger. And they typically will try and stay within the same standard repayment term, whether that be roughly 10 years or so, or maybe even extended out to 25 years through the extended plan. The standard repayment program that a lender or a lender servicer sets you up with typically will be the most affordable, meaning as far as the amount of interest that you pay back. You'll end up paying the least amount of interest in these programs. If you do decide to go with an extended period or a graduated period, you probably will end up paying more interest on those loans. However, remember, if your circumstances change and you find yourself having a little bit more extra money, you can always put extra payments towards your loan. Or if you happen to maybe get, let's say, like a signing bonus or so, you can pay these loans off with no prepayment penalty. So if you do need an extended or a graduated repayment at the beginning, but you're worried about paying more in interest, chances are, like I said, as you mature within your career, maybe you might end up receiving more money through your salary, and you certainly can make double payments or pay the loan off as you wish. The income deferred payments, there right now currently there are what we call the income-based repayment plans. There is income contingent repayment plans. There's what they call pay, and then there's also another plan called save. Basically, what these plans are going to be based on your income and your family size. So what they're going to do is take a percentage of what your income is relative to your family size, and they will set a monthly payment that you will pay for a certain amount of time, typically in upwards of 12 months. At the end of 12 months, you may potentially have to reapply under this program and requalify yourself to make sure that the percentages stay the same. Again, some of these plans might change come July 1st, 2026, but the idea and the intent is to streamline them into a new transition repayment plan. But if you go out to manage your loans, you can take a look at all the different ones that are out there, and you can also play around with the loan simulator and see which plan works best for you in certain scenarios. So, one thing that we like to remind students is if you haven't done so already, hopefully you've been budgeting while you've been in school. And if so, now's an excellent time to start thinking about what your after-school budget is going to be. If you did have a budget while you were in school, obviously there's a good chance that you did not have student loan payments accounted for in your budget. We always advise students to take a look at their budget, modify it as according, especially during various different life changes. Graduation is a fantastic time to relook at your budget and plan for what your expenses are going to be and how they're going to change outside of school. And again, very similar to the loan trackings form that I mentioned before, we do have a budget worksheet at salliemae.com/budget. However, just like with the loan tracking form, if you want to Google and find your own budget or your own loan tracking sheet that works best for you, or if you want to create your own or create your own spreadsheet, just as long as you're doing something in order to successfully plan and manage the changes that are coming and make sure that you can account for your expenses. That's all that we hope that you get from this. But if you just need a place to start and you don't know where to start, you certainly check out ours.
Hey, Jeff.
Yes,
Oh, there go my dogs. I apologize, everybody, as I open up my mic.
sure.
I was going to say that the Student Money Management Center is available for anybody who would like to have a free budget worksheet or have a personal financial coaching session. We are available to help them with that as well.
Excellent. Thank you. Just lastly, here in the home stretch, when you make your payments, you are going to have various different ways that your loan payment is going to be accounted for. When you make your monthly payment, what is going to happen is if you have any additional fees out there, your payment is going to go towards fees first. It is then going to go towards any interest that accrued on that loan, and then whatever is left over will go towards your principal. So if you happen to look at what they call an amortization schedule, or basically it's every single payment over your, let's say, a 10-year repayment term, it will show you how much of it's going to go to fees, how much of it will go to interest, and how much will go to principal. For the first few years, it might be a little difficult to stomach, but most of your payment is probably going to go to interest first, with a little bit going to principal. But over time, that percentage will change. And in the latter half of your repayment term, more of your payment will go towards principal and less of it will go to interest, because your interest just simply isn't accruing as fast anymore because your principal is going down. It's reducing. So it may be a little difficult to look at it first, but over time, if you look at it over, let's say, a 10-year term, you'll see where it makes sense and how you'll actually pay down more principal over time. There are two different ways to pay. I don't want to necessarily devote too much time on this, but sometimes folks want, if you have various different loans, maybe what you want to do is knock out the smallest balance first and then move on to the next and go on and so forth like that. That's called the snowball approach. The avalanche approach is where you actually prioritize your highest interest rate loans and then your next highest and so on. So essentially, the avalanche approach it might be the largest balance loan that you have, but it's also accruing the most accruing the most interest. And so you want to pay that loan off quicker. But a snowball approach is for those that may have multiple loans where they just want to simply, you have 5 loans or 6 loans. You want to get it down to a manageable amount. You just want to pay off the small ones so that you can focus on the larger ones as well. Both of these are common ways to get rid of your debt. I'm not going to say which one's necessarily better because it's whatever fits you best. Again, we talked a little bit about cosigners. If you haven't talked to your cosigner since when you took out a private loan, now would be a great time to touch base with them. And again, a cosigner does not have to be a parent. It can be anybody that you chose that had credit worthiness or eligibility. It could be the person that is most proud of you obtaining your degree. Make sure that you start with the basics. Make sure that they have access to the online servicing accounts so that they can see what is going on with the loan. Make sure that you reinforce the fact that you'll be responsible and that you can take care of this loan. And also, too, if you have anything that happens in your life where it's going to potentially affect your repayment on this loan, letting the cosigner know something about that too as well is great. You certainly don't want them to learn about them being responsible for the loan because you didn't happen to communicate that to them. Also, too, lastly, for some private lenders out there, there may be an option to have a cosigner released from their loans. So meaning that if once you start into principal and interest payments and you make a certain amount of them on time, you may potentially have your credit checked. And if you are in a position where you can be responsible for the entire loan, the cosigner can be released. So you'll certainly want to make them aware of that as too, and let them know that you're going to be taking steps and working towards that if that happens to be in your plans. Lastly, we did talk a little bit about loan deferments and forbearance options. Just to let you know, obviously in-school deferment is the most popular, but there's also economic hardships deferments. There's military deferments for your federal student loans. Again, all of the different types of federal deferment and forbearance options can be explained and learned out at studentaid.gov. I think the best takeaway from this is that if you do find that while you're making your payments, you are struggling or have the potential of struggling, make sure that you are proactive. Go out and research the various different deferment and forbearance options first. Be in contact with your loan servicer and find out what you can do in order to be responsible on your loan. And they can also sometimes assist and find out what deferment or forbearance option is best for you. And as well, with private loans, the same can be said. Again, many lenders out there have either a deferment or a forbearance option. Many of them also have additional deferments for either residency or various different types of internships or clerkships. You'll certainly want to take advantage of that if it applies to you. But again, also, if you do find that you are maybe falling a little bit on some hard times, or maybe income is not coming in the way that you had hoped that it would be, being proactive with your servicers and explaining the situation to them can put you in a situation where they can actually help you as opposed to being reactive. Once you've become delinquent, or if you've missed many payments, maybe you're on the verge of default. Now they have to be reactive and you don't have some of the same options available. But just the big takeaway is that there are options out there for you. Take a look at them either through your servicer's website or studentaid.gov if it's for federal loans, and see which works best for you. Lastly, there are some tax deductions for loan interest. What we recommend is for students to go out and look at IRS Publication 970. Many times the federal government and the IRS change the various different tax deductions year in, year out. So we don't want to put any information on this site that might be out of date. Typically, right about now is where many of the tax deductions for this current year, 2025, will be published, so that when you file your taxes anywhere from January to April in 2026 for the calendar year 2025 is when you'll learn about all of these. So certainly consult a tax advisor or go out and read IRS Publication 970 if you want to learn more about that. So congratulations. Glad that you're graduated, that you're moving on. If graduate school is in your future, congratulations again for exploring that. Last takeaways, make sure you stay in contact with your servicer, update your contact information when you move. Make sure that you read all statements, whether they're coming in via email or whether they're coming via snail mail or regular mail. Anything that you receive from your servicers and such, make sure that you open it and read it, and stay in contact with them. Reach out to your servicer if you have any questions. Again, very similar to the deferment and forbearance options. Being proactive and being in contact with them is so much easier in life than them having to be reactive. You've got so many more options. So with that, Shalise, I'd like to go ahead and open it up to comments
All right.
or
Thank you
questions.
so much, Jeff. Gabby, was there anything in the chat? I know we had some activity going on.
No, there's no questions in the chat.
Okay, was there any questions that our financial aid counselors received that maybe we could share? Let's see here. We have something in the chat here. Let's see.
There was a question about student loan forgiveness program.
Oh, yes.
Sure.
I think you answered this, but is the PSLF still available?
Yes, so basically the Public Service Loan Forgiveness or PSLF is still available and it will be available for some time. However, there are some modifications as to what type of a nonprofit entity will qualify a borrower for. So right now, currently, again, and I hate to do this, but it looks as if it's going to be tied up in some litigation for the foreseeable future. And unfortunately, as of today, what I can say is that there is a public service loan forgiveness program. And again, you can find out more information at studentaid.gov/PSLF. And if you do find that the entity that you're going to be working for is a qualifying entity, certainly take advantage of it if that's what you want to do. But just kind of dropping the notion that because there is some litigation and some differing of opinions in this program, it might change in the future. One thing to note, you will probably have to qualify each and every single year, very similar to your income sensitive and income deferred repayment plan programs. You will have to fill out paperwork each and every year, as well as you will have to go into a qualifying loan repayment program on studentaid.gov in order to qualify for public service loan forgiveness. So you will have two sets of paperwork that you need to fill out. The paperwork to keep you qualified in your income deferred or income-based repayment plan, as well as the paperwork to qualify you for public service loan forgiveness.
That's great advice. With anytime you borrow money, you always have to stay on top of the situation, and especially with money that we've borrowed from the federal government. This is an investment in yourself, and just own it and just stay on top of it. And as always, reach out and ask for help and seek guidance. And studentaid.gov will have the latest and greatest information for sure. Anybody else have any questions? Do any of our participants, if you don't want to put it in the chat, you can unmute if you'd like and ask the question. We've got just a few more minutes here with Jeff. and our financial aid counselors?
I have some thoughts, Shalice.
Sure, absolutely.
So for the students that are graduating and they're going into like their undergrad going into grad program, you do need for the spring semester, you do need to correct your FAFSA from undergrad to grad. Okay, so that we can process you as a grad student. If you need help with that, contact our office and we can guide you and give you assistance on how to do that. Also, uh, the Department of Ed requires us to prorate federal direct loans, subsidized and or subsidized, if a student is enrolled in less than 24 hours in a summer fall semester. So if you are enrolled in less than 24 hours and graduating in August or December, we are required to prorate your loans. And we do, you'll get an email from our office if that occurs on your federal student aid loans.
Thank you, Brandy. This is why we bring all the experts together for you students, because the nuances in financial aid, and especially in federal student loans, they're so deep. And so thank you for, again, let me just say, we really appreciate all this wonderful information, the updated on student loans, repayment options. It's consistently changing. Please reach out to us. Check out studentaid.gov. And we want to thank our financial aid experts for being on the line with us as well. And for the students who took the time to participate, and for those who are watching us in a replay, thank you for clicking on our YouTube channel, and thank you for reaching out to the SMMC for wonderful financial and personal finance topics such as this one. For those of you who are online, make sure you fill out the survey when you exit the Zoom. We really do appreciate the feedback for that. Congratulations if you're graduating in December. Congratulations if you're graduating in May. This is wonderful news. And we really do hope that you have a nice night. Again, thank you so much, Jeff, for stepping up and being part of our presentation today.
Thank you for having me. Thank you, everyone, for attending.
Good night, everyone.